They are telling us part A, we prepare a statement of cash flows for the year ended 30th April 2022 using indirect method. This is also indirect method in accordance with IAS 7, that is statement of cash flows. For which company? What are they telling us? They are telling us that SCL manufactures and supplies concrete products as well as building materials. The company has 3 concrete plants, which the company has 3 concrete plants with administration offices in Kampala. So I don't want to waste time reading through. I first lay my template. So that is your heading. That is your heading. You're preparing this company statement of cash flows using indirect method for the year ended the 30th April 2022. So you put here details, then here you put your workings. If you do the workings, you put there your workings. Then you put here the amount and also the amount here. Okay. We can keep our amounts in what? When you look at the financials given in this question, the examiner kept the figures in a thousand. So we can also keep our figures in a thousand. Okay. This is shillings a thousand. Then also the other side a thousand. Okay, so that's what we have. That is our template. That is our template. When you're dealing with a number about cash flows, take note that you can be given income statement, or you can be given also the balance sheet. You can be given 2 things: a statement of profit or loss and other comprehensive income. Also, you can be given the balance sheet. That is statement of financial position. But there is a situation where you're going to find that you are only given a statement of financial position. Okay, so here are we given both, or we are given only one? They are telling us that you are the accountant of SCL, and the chief finance officer has provided you with the information relating to the statement of financial position. So here you have statement of financial position as at the 30th April 2022 and 2021. So you have 2 years. Okay. Are we given income statement? We are not given income statement in this question. So you are not given income statement. So how are you going to start? Remember, when you're using indirect method, you normally start with profit before interest and tax. That's what you normally start with. Profit before interest and tax. So are you given this? You are not given this. So if you're not given this, what are you going to do? Because you normally pick profit before interest and tax from the income statement. That's where you normally pick this. But in a balance sheet, what you have is retained earning. In the balance sheet, you have the retained earning. You have the retained earning for the year 2022. You're preparing cash flows for the year ended the 30th April 2022, and you have the retained earning. So this retained earning comes from obviously your income statement. The earning, just to know that it is the money retained after paying dividends. Okay? Retained earning is basically what the company retains, what the company remains with at the end of the year. Okay? So this one comes from profit after tax. That is profit after tax. Then you raise whatever you paid to, or whatever you declared to, whatever you declared and paid to the what? To the shareholders. So it means that we will need to do the working. And as you do the working, in additional information, they will give you some other things. Like now, when you see here note number 4, when you look at this note number 4, they told us that income tax for the year ended 30th April 2022 amounting to shillings, this, you have the income tax, was provided for in the financial statements, was provided for. So it means that when this company was preparing income statement, they included this. While the net interest charged as indicated from the bank statements for the year amounted to this. You have the net interest. Okay, so how are you going to get profit before tax, and how are you going to get profit before? How are you going to get profit before interest and tax? But also, as you try to read through, you need to first know whether the company declared dividends or whether the company paid dividends. You need also to check and see. These are some of the things as you read, as you utilize those 15 minutes in an exam. Those are some of the things you try to find out. Are you given the dividends? Of course, now when you check in the balance sheet, you have the dividends. So it means that there must be the dividend that was declared during the year. Let me see. Or you go to additional information and first check. And when you check in this additional information, they told us that in a shareholders meeting held on 1st January 2022, the shareholders declared shillings 50,204,000. That's what they declared as dividends based on the previous year's performance. And no dividends were proposed for the year ended the 30th April 2022. But remember, they are proposing this dividend in the year you are trying to handle. They are proposing this dividend in the year you're trying to handle. So what does that one mean? What does that one mean? It means that you will need to test and see. Test and see. First get this the difference between this one and this one. First get the difference. This one and this one. What do you get? First get the difference. I want you understand these things very well, because some of you can end up making a mistake. Yeah? So when you check this, the difference between this one, this figure, and this one, it cannot give you what? It cannot give you. Okay, the difference between these two values cannot give you 50.2 million. So what does that one mean? It means that you get 42,100.
Yes.
Okay. So it means that is not what was declared. But what are you going to do with this? Okay, let me try to do the working and you see. So when you are handling this, we are trying to get note number 1. Note number 1, we are trying to get profit before interest and tax. And how do we get this? How do we get this? First of all, you will need to first get you will need to get the profit after. You need to get the profit after tax. You need the retained earning for the year. Retained earning for the year. How much?
42,100.
20 what?
42,100. I'm getting 277,100.
Moses, how are you getting that value? That is
277,100.
Yeah,
277,100.
she's right.
Okay, then remember this retained earning. You get that retained earning from the profit after tax. You get that retained earning from profit after tax, and after declaring the dividend. So what you're going to do, remember you want profit before tax. You work backwards. Okay, how do you get this? Obviously, it means that you removed the tax, you removed the dividends, you removed the interest. So you are going to add back all those things. So you add back, first of all, you add back the dividend that was declared during the year. Dividends declared during the year. At this point, you don't know how much was paid, but you know what was declared. You first deal with what was declared before getting what was paid. Okay? How much was declared? It is from additional information. You saw that what was declared is 50,204. Okay? Okay? Then we add, now what you get here will be profit after tax, because it's where actually what you're getting here is profit after tax when you get this plus this. But for you in an exam, you don't need to do that. Okay, you add. For you, you simply list. We are working backwards to get profit before interest and tax. So you add what? This is profit after tax. So I add back the tax, the income tax for the year. The income tax for the year. What is the income tax for the year? They gave us the income tax for the year. The income tax for the year was this one. So you just bring this. You're working backwards to get profit before interest and tax. So you add back. So when you get profit after tax and you add back the income tax, basically what you're getting is profit before tax. Okay, so you get this plus this. That is profit before tax. But we need profit before interest and tax. So it means that I must add back what? The interest. The interest for the year. The interest for the year. The interest for the year. What is the interest expense? The interest expenses for the year. What are our interest expenses? Interest expenses for the year. What are our interest expenses for the year? They are here. So you add back at this. You add back at that, okay? You add back this. So it means that when I add back at the interest, it means that I will be getting profit before interest and tax, which is the one that I need. Okay, you get this plus this. But in an exam, you don't need to waste time getting the profit after tax, getting profit before tax. Okay, for you, simply add dividends declared, add income tax for the year, add interest expenses for the year. What you will get will be the profit before interest and tax. Are we all together on this? Please, you need to master this. Are we all together?
Yes.
Master the steps. Remember what we did last time? We handled the scenario where you're given profit after tax. Then actually we had profit before tax. Then you add back the interest expenses. Because you have profit before tax, you simply add interest expenses. But if you have profit after tax, you add back income tax, you add back interest expenses. Okay.
Excuse
so
me, Mister. Assuming like you are given like dividends in maybe 2021, then dividends again is appearing in the balance sheet of 2022, then again dividends declared. So how would I
that
tackle
is what
that?
we have.
Okay.
You see here we have 2022. Are you seeing
Mm,
Moses? We have
yes,
2022.
yes.
We have 2021. Okay.
Mm,
So you have dividends here. You also have dividends here. But
okay.
remember, as you do this, you need first to know what was declared for the year. You need first to know what was declared for the year. What was declared for the year is this one. For you, you're dealing with a year. What was declared for the year or what was proposed for the year is this one. First, know what was declared. After knowing what was declared, you will do the working. Actually, I can do maybe to avoid that confusion. I can do the working and I know what is the dividend that was paid during the year. Because what was declared can be different from what was paid. You get it?
Yes.
It can be different. So for you, let me just maybe do it. Let me also do it from here. If you want to know what was the dividend paid for the year, dividends paid for the year, dividends paid during 2022. How do you get this? First of all, you need to first look at the balance brought down. That is the dividend payable. Remember, dividend payable comes from what was declared and not yet paid. You get it? You declared or you proposed, you declared that you're going to pay dividend, but you have not yet paid it. So that is dividend payable. So dividend payable at the start was how much? 65,200. That is the dividend at the start of the year, the dividend payable at the start of the year. Okay? Now, that was at the start of the year. Then during the year, the company declared some dividends again. So you add what the company declared during the year. Dividends declared during the year. What was declared during the year? What was declared during the year is how much? It's this 50,204. So after knowing what was declared during the year, so you expect to be this one. This is expected. This is the expected balance carried down. Okay, this is what you expect at the end of the year to be dividend payable. You get this plus this. But you see, but what you have in the balance sheet, but the actual balance carried down is how much? What do you see at the end of the year? What do you see in your balance sheet for 2022? The balance you see is what? Are you seeing this? The actual is this. The actual dividends payable is 107,300. That is the actual. The actual. So the question is when you compare, does this one tell you something? Does this one tell you something? You expected the dividend payable to be this, but the dividend payable is this one. What does this one mean? It means that during the year, the company paid what?
Some dividend.
The company paid some dividend paid. So that's how you get the dividend paid. You get this minus this. So this is what will be recorded as this will be part of our financing. Remember, this is always part of your financing what? Your financing activities. The dividend paid is always part of your financing activities. So you know when you're handling the financing activities, financing, don't forget this financing activities. As a cash, this will be a cash outflow. This will be a cash outflow. Is it now clear? Is it clear?
Yeah.
All right. So it means that when you're handling this, when you're handling the component of dividend paid, you first know what was the dividend at the start, the dividend payable at the start. You add what the company declared during the year, because what is declared is not yet paid. So you add back what the company declared, then you will be in a position to get the expected balance carried down. Compare that figure with the one in the balance sheet at the end of the year. So the difference will be dividend paid. Now, in a scenario where you don't have this statement, because also that one can happen. In a scenario where you don't have this statement, what will you do? In a scenario where in the question they didn't say that a dividend declared during the year were this, what do you do? For you, when you're handling this, you get your retained earning, then add back the dividends. The dividends that you're going to add back will be the difference between this one and this one. The difference between this one and this one. That's what you will add back. Because in that scenario, it means that they didn't declare anything. And that will be also the same amount as dividend paid. So there are scenarios where you find that there is nothing that was declared. So for you, as you add, you simply add the dividends paid. The dividends paid. All right. So here we are going to put this figure. After putting this, I will do what? Remember now we add non-cash expenses. In an exam, just answer. Don't be specific that non-cash expense. Just read it through and see whether you have those. Because you'll be adding back non-cash expenses, then you raise non-cash incomes. Okay? Before looking at the changes in working capital. So what are non-cash expenses? We talked about them last time. Non-cash expenses, you have depreciation, you have amortization, you have impairment. All right, so let's now move non-cash expenses. Where are you going? You need to look for notes that talks about like depreciation, like revaluation. Like now you have depreciation here, you need to take note. Then here you have a component of revaluation, you need to check because they said that they were included in the statement of financial position. So you need to check some things. I think that's all here. Now, and also you need to check because they told us that some assets were, there is an asset that was disposed of. Okay, so you need to check, do you have a profit on disposal or a loss on disposal? Those are some of the things you need to be knowing as you tackle a cash flow number. Okay, so how do we get the depreciation for the year? When you look at this question, they told us they told us that the depreciation charges for the year ending 30th April 2022 made in the statement of profit or loss were distributed as follows. So you have depreciations for the year. This one, this one, this one. So automatically you have to add back that depreciation. When you add this, this, and this, what do you get? What do you get? Because this is the land and building, plant and machinery, motor vehicles. These are depreciation. So add and tell me the total. The depreciation for the year. The total of those values. And that is how much? That is, you said it is 19 what? 19?
195,600.
600. You can add on the face. In an exam, you add all those figures. You add 117 on the face. You add. Then plus the other one is how much? 5, 5, 2, 5,
160.
5, 2, 160. Then plus what?
26.
Plus
26. 080.
0. Is it 08 or 08? 08.
Yes.
So that's how we are getting this figure. That's how we are getting this figure. Okay. All right. That is the depreciation for the year. But before you proceed, now I want, when you're handling this, you can work these things concurrently. Before you proceed, when you're dealing with the PPE, one, you need a depreciation for the year. Number two, you need to see whether there was revaluation. Number three, you need to see whether there was disposal. Those are three things you need to find out, because it will help you to know whether you have assets that were acquired during the year. What do I mean? You are going to do the working, because in the question they specified. Let me do now. This is working number 3. Working number 3, you're looking at PPE. You need to know whether the company acquired more assets. You need to know whether a company acquired more assets. And how do you get this? First, the first part you always need to do. First, handle the component of the disposal. First, see whether you see your non-current assets. You have land and building, you have plant and machinery, you have motor vehicles. Also, down they gave you the depreciation for each. But number 2, they told you that during the year, an item of machinery, they specified machinery, an item of machinery with a cost of shillings 97.8 million and accumulated depreciation of 78.24 million was disposed of. But they are telling you that the remaining items, what are the remaining items? The remaining items from where you picked machinery. You picked machinery from plant and machinery. So the remaining items, because we see that there was an asset that was disposed, we first get profit. We first see whether we have profit or loss. Profit or loss on disposal. Because there was an asset that was disposed of. Okay, what was the cost of machinery from this question? Because it's the machinery that was disposed of. The cost is 97,800. 97,800. That is the first. Okay, but they are telling us that the accumulated depreciation, the accumulated depreciation of this machinery was how much? The accumulated depreciation of this machinery was how much? The accumulated depreciation.
240.
Pardon?
It was 78, 240.
Yeah. So that is our accumulated depreciation. So when you get cost minus accumulated depreciation, what do you get? You get net book value. This one minus this one, you get net book value. Compare this net book value with the disposal amount. What is the disposal amount? See whether you have a loss or a gain. What was our disposal amount?
32,600.
32,600. So do we have a loss or a gain?
That's a gain.
At the time of disposal, you are seeing that your asset is at this amount, but you received this. So you have a gain on disposal. Very, very key, colleagues, when you're handling cash flow. Whenever you see that you have an asset that was disposed of or that was sold, you need to do the working to see whether you have a loss on disposal or a gain. Because a gain or a loss on disposal doesn't show cash movement. There is no cash movement here. You're just, these are just for purposes of valuation. For purposes of valuation, but there is no cash movement. There is no cash. This gain you see, there is no cash movement. It's basically the result of comparing the values. Okay, so this gain is non-cash. This is non-cash income. This is non-cash income. If you get a loss on disposal, that is a non-cash expense, which you must add back. And if it is a non-cash income, we are going to remove it. This income is part of this one, but it is non-cash, which we must remove as when we are handling non-cash incomes. Please take note. That is number one. We are done with that. So we have gain on disposal. After getting the gain on disposal, go ahead and see now. Go ahead, because this revaluation, colleagues, this revaluation you see here, they are talking about the revaluation. You compute revaluation loss or revaluation gain, or you add back or you subtract. In a scenario where examiner had told you that maybe the revaluation gain was part of the other incomes. Okay, so let's first deal with the machinery. Let's see. Let's first deal with the machinery. Let's see. When you look at our machinery, we want to see whether the company, when we look at the plant and machinery, the plant and machinery, we want to see whether the company purchased more assets or not. You need first to get the balance brought down. The company started with how much in the question? The company started with plant and machinery to this one. That's what they started with. Okay, then you do what? Balance brought down, then you do what? You add, remember what I said last time, you add revaluation again. If it's there, You add revaluation gain. Do you have revaluation gain? How do you know that you have revaluation gain? How do you know you have revaluation gain or revaluation loss? Because they said that the remaining assets were revalued, the remaining items were revalued, and the effects of the revaluation were included in the statement of financial position. So you go to where you have revaluation reserve. Where you have revaluation reserve, it means that the revalued amount was this one, the revaluation gain. Remember, revaluation gain is part of the reserves. So this is what you have. If you have two figures, then you get the difference between those two figures. If you have an increase in revaluation, that will be revaluation gain. If you have a decrease in revaluation, that will be a loss on revaluation. So because we have only this is a gain. This is the revaluation gain, which must be added back here. Because this revaluation is on machinery. It's on the machinery. Okay. Then we add back what? What I said, we add back there is the asset. Maybe it could be the company is the machinery, you add back that one. But in this question, we don't have is the asset. But in your workings, you need to know that we add back there is the assets if they are there. Okay. Then after that, we raise. We raise first of all, you raise the disposal. You raise the disposal. You raise the disposal. First of all, before I go to disposal, you raise the depreciation. The depreciation for the year. What was the depreciation for the year when it comes to machinery? Depreciation, plant and machinery. What was the depreciation for the year? Plant and machinery. Plant and machinery, it was 52. It's here. Plant and machinery depreciation for the year, it's this. Please erase. Don't forget to put it as a negative. Okay. Then what else do you remove? You remove disposed of. Its net book value was how much? Because that one is no longer part. So you remove. That was how much? What was the net book? It was this one. So you remove that figure. Okay. So once you remove the asset that was disposed of, the remaining balance will be what you expect. Sorry, if you have the revaluation loss, you also remove the revaluation loss. But you cannot have revaluation gain and revaluation loss at the same time. No, it should be one. If you have revaluation loss, you remove the revaluation loss. So here you will be having the expected balance carried down. And that is how much? That is how much for you. You use your calculator very well, right? So that's what I have. That's what I have. So from this, I am going to, but when you look at the actual, what is the actual in the balance sheet? But the actual balance carried down is how much? At the end of the year, what is our PP? What is our plant and machinery? That is at the end of 2022 in the balance sheet. When you look at the balance sheet, the net book value is this one. You started with this, but now the net book value is this one. So it's what you're going to put here. You put it here. So the question is, do you have the acquisition? Did the company acquire more? Because you expected the balance to be this, but now the amount is this, the balance is this. So it means that the company acquired you have the acquisitions. The acquisition. This is the acquisition. the acquisitions for the year, or the additions. You have the additions made during the year. It means that the company purchased more plant and what? More plant and machinery. Okay, it means that the company purchased or acquired more plant and machinery. So this one will be part of, it will be, this will be part of, this will be part of what? Who can tell me part of the investing? Part of the investing activities. Part of the investing activities. This will be part of, this will be part of investing activities. Remember, under investing activities, test and see whether the company acquired more or sold more. Okay, let's see. The balance brought down is how much? Balance brought down. Here we are looking at net book value. Net book value, the one in the balance sheet. Land and building. Can you hear me, guys?
Yes.
Let's try to be fast, because here we don't have a lot of things. We don't have, then we add the revaluation again. We don't have revaluation again when it comes to land and building. But we have the depreciation for the year. So we less the depreciation for the year. Depreciation for the year. Depreciation for the year, when it comes to land building, it was how much? It was this one. Okay, that was depreciation for the year. But you can make it as a negative. Okay, do we have this? Do we have the asset that was sold like a building or land? No. So you don't need to remove that. So the balance you get here will be, you don't have revaluation loss, so I can simply get expected balance carried down. So you get this minus this. But when you look at your balance sheet, what is the actual? What is the actual? Actual balance brought balance carried down. At year end, what is the net book value at year end? Net book value. When you look at net book value at year end, the net book value at year end, the net book value at year end, land and building, it is this one. So did the company acquire or they disposed? Compare and tell me. Do you have acquisitions or the disposed? Because if the figure you have as actual is higher than the expected, it means that the company acquired more. So you have the additions. You have the additions made during the year. So this one will also be part of the, financing, rather part of the investing activities. Colleagues, this amount on where we had this, I want you also, before we forget, I want you make sure that this one you say this will be part of, this will be part of investing activities as cash inflow, because this is the money you have received. This will be cash inflow when you're handling investing activities. The disposal amount, because you have received that money, it will be part of your investing activities. Okay. Okay, so lastly, we have another asset called what? The motor vehicles. the motor vehicles, the motor vehicles, the motor vehicles. What is the balance brought down? The balance brought down. The net book value at the start of the year. Remember, if you have cost and accumulated depreciation, you get the difference. The difference. Okay. How much do you have at the start for motor vehicles? At the start for motor, these numbers are not hard, but they tend to take time. But they are not all that complicated. When you are familiar with these ones, the flow, and the flow doesn't change. So you don't have revaluation gain. So you simply less the depreciation for the year. And what was the depreciation for the year here? When it comes to motor vehicles, the depreciation for the year, it is 26,080. 26,080. That is depreciation for the year. Okay, colleagues here, you don't have the revaluation loss, you don't have any vehicle that was disposed of, so you can simply get the expected balance, carried down, and that is how much you get the difference. This one minus this. That's what I have. What was the actual? But the actual balance carried down. The actual is how much? The actual from the balance sheet. The actual is this one. The actual is this. So do you have the additions? Yes, the actual is higher than the expected. So you have the additions. So these are additions made during the year. And that figure will also be part of this will be part of the financing. It will be part of the financing activity. Financing activity part. You will simply have the component called acquisition of PPE. And the acquisition of PPE, so colleagues, in your investing activities, you don't want to put one by one. That is wastage of time. Just to get the total, and in your cash flow, you will have one component called acquisition of PPE, and this will be under what? Under investing activities. And that will be what? That will be cash outflow. It will be cash outflow because acquisition you're spending. This will be cash outflow. So take a note. When we are handling investing activities, remind me to include this. Also remind me to include this disposal, because that is money generated from your investing activity. All right. Do we have, when I look at, by the way, we are almost done. You see the beauty with cash flow. As you do those workings, you're almost done with the number. When you look at additional information, we have almost everything. Do you agree? Because we have looked at one, we have three.
Yeah, the remaining ones are not.
We have looked at note number 3 and note number 4. So what are you left with? It's just a matter of playing with what? With the balance sheet.
Working capital.
Let me hope you can. Let me hope you can hear me. Guys, are you on?
Yes.
You see in our question, do we have intangible asset? Because if you have intangible asset, you test to see whether you have amortization. You don't have intangible asset. So it means that there is no amortization here. So I'm done with the non-cash expenses. I can look at the IAS non-cash incomes. From this question, what are our non-cash incomes? Our non-cash incomes, we only have the profit on disposal of machinery. It's non-cash because you're just comparing. This is a gain. Profit on this is like gain on disposal, gain on disposal of machinery. It's non-cash. It's not like you have received this. No, what you have received is disposal amount, but not gain on disposal. Okay? So it means that what you're going to put as your non-cash income is this figure. That is your non-cash. Gain on disposal is not a cash income. It's not a cash income. Have I picked the right figure? Have I picked the right figure? That was our
No.
our gain on disposal.
It
Looks
was
like
13,040.
it is this one is this it's this oh okay 13. That is 13. 13 0.
13,040.
But let me hope you have understood it.
Yes, we have got it, but I have got some question to ask.
Yes, go ahead.
That why are we removing a gain on disposal? Yet, like when you are selling an asset and you are selling an asset and you are receiving money. So isn't it a cash inflow?
Yes, it's cash inflow. Are you seeing, let me show you. Are you seeing this disposal, the one I highlighted?
Yes.
The disposal amount is the one that is cash inflow because you have received that money. It is cash inflow which will be included under investing activities. You get? This is
Yes.
cash inflow that will be included under investing activities. But when it comes to gain on disposal, gain on disposal is not money that you have received. No. Gain on disposal, you have not received that money. Do you agree? You have not received that money. It's just because of the movements. It's just because of comparing two values, the net book value and the disposal amount. But you have not received that money. You have not received that money. That's why we are saying that gain on disposal is a non-cash income. You have not actually received that money. You're comparing just two values. So because it's non-cash income, you remove that income from this one. Remember, it is part of this. So I want to remove that income from this figure. So to remove that income, I subtract. Is it clear?
Yes.
Okay.
I've got the point now.
All right. So the next part, next it will be what? Next it will be Do we have any other non-cash? We don't have, but please put this is working number what? This is working number what? The gain on disposal, that was our working number what? Number 3. That is working number 3. Okay. Then next, I think we are done with that. Next, we look at, we don't have any other non-cash income. Non-cash incomes, we don't have any other. So we look at changes in working capital. Changes in working capital. And now these ones are very easy. Just be looking at your balance sheet. Changes in working capital. Now we are going to be looking at this. You look at your current assets and current liabilities. Current assets and current liabilities. Inventory, do you have an increase or a decrease? This is a decrease in inventory here. Initially you had this, now it's this. That is a decrease in inventory. A decrease in inventory is what? Is it an inflow or outflow? Decrease.
No.
Decrease in inventory, it means that you have sold. Decrease in inventory, it means that is cash inflow. So it is 537 900 minus 384 680. How much do you get? That is 153 120. Next, you have receivables. That is an decrease in inventory is an inflow. You have sold your inventory. It means that the difference is what you received. Okay. Then next is trade receivables. Initially you had this, now it's this. An increase in trade receivables is what? We have an increase in trade receivables. Increase in trade receivables, even inflow or outflow?
Outflow.
Increase in trade receivables. That is the outflow. An inflow put a negative 215 160. Okay. Then next you have now you're done with let me see, you're done with assets when I look at my question, because short-term deposits, short-term deposits, those ones are too liquid. Those ones you don't look at them. Okay, we are handling trade payables. Increase in trade payables. Increase in trade payables.
Just
When you are talking about the short term,
continue.
Moses network, or it's my network, I don't know. Increase in trade payables is what? Increase in trade payables is a cash inflow, because there you have received more. Yeah, it's a liability, but an increase in liability actually in terms of cash flow, an increase in liability is cash inflow.
No, it is not me. I see that is just from Rashida.
Rashida, is it my network? I can't hear Moses very well.
no, it's Moses' network. You're clear.
The cash
I also can't hear
inflow.
you correctly.
Okay. Let me wait for him to be stable. Here, in increase in trade payables, you get 74. The difference 74,008 is 980. Next is what? Next is when you look at your current liabilities. When you look at your current liabilities, you have also the taxation. you have taxation, so you need to do the working to know how much you paid during the year. So let's do the working. Let's do the working. Please, this working is very, very key for taxation, to know how much the company paid during the year. Let's do the working here, another working. This is working number what? Working number 4. Working number 4. We need to know what is the tax, income tax paid. Income tax are paid during the year. And how do you get that? You're going to get the balance brought down. That is like tax payable at the start. What is the tax payable at the start? So when you look at the question, the tax payable was how much? This one, the one you have in the balance sheet. When you have a taxation component in the balance sheet, it means that that tax is not yet paid. It's still outstanding. Okay? So that is the one we start with. Then you add the income tax expense for the year. The income tax expense for the year. And when you look at the question, we had seen that when you look at note number 4, income tax for the year ended 30th April 2022, amounting to shilling this was provided in the financial statement. So this is the income tax for the year. We add back at that. We add this here. Okay, once you do that, remember this is income tax expense. Income tax expense doesn't necessarily mean that that income tax was paid. No, it's just income tax expense for the year. You know what was paid after comparing the expected. Here you have the expected balance carried down. You compare, you get this plus this. Then you compare, you say, but what was the actual? The actual balance carried down from your balance sheet. What is the tax payable? What is the tax at the end of the year? The outstanding tax at the end of the year. At the end of the year, the outstanding tax or the tax payable is 195,600. Okay. That's what you're going to put here. That's what you're going to put here. So the question is, how much did this company pay as income tax during the year? You expected to find the tax payable to be this, but now the tax payable is. So it means that the difference between these two figures is what the company paid. This is income tax paid. That is income tax paid. This one minus this one. This is income tax paid. And income tax paid comes immediately after cash flow from operating activities. This is cash outflow. This is cash outflow. It means that the company paid that money. It will come later. Okay? So after getting my net cash flow from operating activities, I will include the interest paid. I also include the tax paid. So I leave it at that point. Any question? Any question on how you determine? Any question on how we determine this? Someone had a question? Yes?
Yes. Assuming I use T accounts, will I be marked wrong, or will I be able
No,
to
T
get
account.
these very answers, or that one may take me away.
T account is also very okay. T account is
Come
also
again?
very, very okay. But it wastes time.
Okay.
It takes time. It takes time. But if you know how to use T account, it is very, very okay. Like now here, like now here when you're using T account, but I don't encourage that. It wastes time. You put here income tax payable. Okay, let me just do one account. Income tax payable account. Remember, if it's a payable account, that is a liability. Okay. Now, since this is a liability, you expect the balance carried down to be this side. Liabilities have credit balance, so balance brought down at the start. Balance brought down at the start, it's basically this one. That's what you put. Then balance carried down, you put it this side down, balance carried down. You put it this side. Balance carried down, where is it? The actual balance carried down is this one. Now you ask yourself, what was the tax paid during the year? Remember when you pay the, okay, you put, you ask yourself, what were the income tax expenses for the year? Income tax expenses for the year. Income tax expenses for the year. You debit an expense account, that is PL, then you credit a liability. You debit a PL, then you credit a liability. So it means that here you add the income tax the income tax for the year. Income tax for the year. Income tax for the year. That is how much? Income tax for the year. I don't really recommend that you use this approach. It takes time and you can be confused. Income tax for the year is what? Is this one?
128. Yes.
And now, once you have this, you close off. You close your, it wastes time. You close off. Which side is higher?
Credit side.
So add the total. The total, you get this. You get this plus this. Then, of course, it's what you put here. So you see that the debit side is not balancing. So the balancing figure, will be the one called the income tax paid. Because when you pay the tax, the liability reduces, isn't it? The liability reduces.
Yes.
So for that liability to reduce, you have to debit with the income tax paid. You debit the income tax paid. That is an expense account. You credit cash, or you credit. Okay, you reduce this one. The best way, income tax paid. Okay. So here, what is the difference? The difference is this one minus this. You have the same answer. You get it, but really, you see, this takes time. But it is very, very. It's very, very okay. It's very, very okay if you are familiar with it. Are we together?
Yes.
Okay. So going back at our format, do we have any other current liability from this question? We don't have. Okay. Oh, sorry. We have dividends payable. But you see, with dividend payable, I told you, you have no business with dividend payable. For you, you need dividend paid during the year. And we had done that working at the start. The dividend paid. We have this, the dividend paid. You first know the dividend paid, but the start, you add what was declared during the year. Because once you declare, it doesn't mean that you have paid. It's like a liability. So compare the two, the expected with the actual, then the difference will be dividend paid, which is what? Which is a financing activity. All right, just what I need. Do we have interest paid? Yes, that we have it clearly. So what I'm going to do, is to just let me get the net, let me get the cash flows, the cash flows from operating, from the core operating activities, from the core activities of the business. You add all these things. You add, to me who is using the laptop, I can simply do like this. But for you, you have to make sure that you get this plus this minus this plus this minus this plus this, then you get this. Once you get this, you will now bring the component of, you will bring the component of interest, interest paid, and also bring the component of tax paid, income tax paid. What was our interest paid for the year? Interest paid for the year was how much? Interest paid for the year was how much? We saw that from the question. And already we had added back at that. Interest paid for the year was this one. Eh? You see this, the interest charged, this one. We had done that to get, you see, when we are getting profit before, interest and tax, we added the interest expense, that one. So it's what you're going to bring here. Put it here. Okay. Remember, interest paid is a negative. That is cash outflow. Then what is our income tax paid? That is from working number 4. Our income tax paid is how much? Our income tax paid from note number, I think this is note number 5. Note number 5, income tax paid is this. Income tax paid is this one. This is note number 5, but it should be negative because it's a cash outflow. So finally, get your figure here. Get this, then you subtract these figures. You will have net cash. What is it, an inflow or outflow? Net cash flows. If it is a positive, you will say net cash flows from operating. Net cash flows from operating activities. If it is a negative, you say net cash flows towards operating activities. If it's negative, if you get this figure plus minus this, me I'm saying plus because of the laptop. But if you get this figure minus this, and you get a negative answer, you don't say net cash flows from, you say net cash flows towards operating activities. You say from if the answer is positive. Okay, so we have net cash flows from operating activities. Then the next component we are going to look at now, the investing, the cash flows from investing The investing what? The cash flows from investing activities. Investing. We need the cash flows from investing activities. That is the next component. And we have everything, we just needed to substitute. When you're dealing with investing activities, you look at non-current assets. Non-current assets and the intangible assets. Okay, so you saw that we already have our acquisitions. Acquisition of what? Of PPE. That was not number what? That was what? Not number. That was not number what, colleagues? That was not number what?
Number 4.
That was not number 4. And the figure is how much? Okay, so what else do we have? What else did I say that we put here? Of course, we have we have the disposal. The disposal of what? The disposal of machinery. And that was how much? Moses, your network today, hey, you are like me. Machinery, it was how much to this? Okay. That's where I told you that it will be part of what? It will be part of the investing activity as cash inflow. That disposal amount. Okay. So this is the cash inflow. You don't put it as a negative. But acquisition of PPE, you put it as a negative because the company is going to spend that money. Okay. So for you in your workings, you put that figure in a bracket. Do we have any other? When you look at our question, actually those are the only things we have, because when you go to the balance sheet under non-current assets, you have land, you have machinery and motor vehicles. So all you need is to see whether the company acquired more or whether the company disposed. Where the company disposed of some of the assets, and we have done that. So you have no any other business. You don't have the intangible assets, so no business here. So you can immediately get net. What is your net cash? Net cash flows. Net cash flows towards, because the answer is negative. This is towards the net cash flows towards investing activities. Because when you get this negative, this plus this, the answer is negative. So that's why I'm using the word towards. Colleagues, are we on the same pace? So lastly, we need to look at cash flows from financing activities. Cash flows from the financing activities. Now here you need first to deal with the capital to know whether there was issuance of shares. Now, how do you know that this is? You can call this one. This one proceeds from issuing. From issuance of shares. So when you look at your share capital, When you're dealing with financing activities, I told you that you'll be looking at what? You'll be looking at equity and what? Equity and long-term liability or non-current liability. So go to your equity. Go to your equity. Can you hear me? Confirm. I see my network breaking. Confirm whether you can hear me.
Yes, we can hear you.
Okay, and under equity, you have share capital. See the movement. See the movement? Initially, you had this, but now you have this. So the movement is what you actually received. The share capital increased. So that is cash inflow. The same applies to share premium. You had this initially, and here it's this. So it means that also share premium has increased, and that is cash inflow. So simply get the difference between this one and this one, add the difference between this one and this one. Just tell me one total. Or you can look at each separately. Say increase in what? The increase in share premium is an income. Guys, tell me you can do the workings at on the face. You get 1,467,000 minus 1,304,000. What do you get? That is two. No, just help me and do that. 166,000. Let me hope it is okay. Then here the difference is 195,600 minus 114,100. Here, how much do you get? Guys, put some speed. I thought we were supposed to do, we are going to do two numbers, but the way time is going. Are you getting these, guys? Guys, are we together?
Well, for shares, I'm getting 163,000. You have 166,000.
Okay, here I put 3, like this.
Yes.
Okay. All right. Then next, do we look at equity again? The revaluation, don't put it here because already that revaluation was part of the what? Was part of our affected our investing activities. Don't include it here. Revaluation here. Revaluation affects your PPE. And we have already considered that revaluation when we are handling this. This is where we use the revaluation. Okay. All right. Then we look at the non-current liabilities. The non-current liabilities in the question because we are done with equity. So let's look at the retained earning. You have no business with retained earning. With retained earning, you just need to use retained earning to get profit before tax and before interest and tax. So non-current liabilities, you have long-term loan. If the liability increases, what does that one mean? Because initially it was this and now it's this. Is it cash inflow or cash outflow? Here you have increase in long-term loan. Inflow or outflow?
Inflow.
It was 119 at 3160 minus 570 500. The difference is of how much? The difference is of how much?
6, 2, 2.
Just a
6,
minute.
0.
Just a minute. I go back at the workbook. It's 6. 6 what? 622.
6,
6.
0.
6, 0.
That's what you have. That is an
Yes.
inflow. That is an inflow, so you don't put it in bracket. What else do we have? Do we have any other non-current liability? Let me see. We are done. We are done. So you add those figures to get your net cash flows from financing, because this is a positive, from financing activities. When you add it is this plus this plus this. That's what I have. So finally add your 3 components. You get this plus this plus this. That's what I have, and this is a positive. So this is an increase. This is an increase. This shows that this is an increase in cash and the cash equivalent. Or you can call it net cash inflows, but the right word you can use, increase in cash and cash equivalent. Then once you have that, you are going to add. You're going to add what was the opening cash and cash equivalent. What was our opening cash and cash equivalent? How do you get this? You look at the last year. The last year, what was the cash and cash equivalent? Last year, that is 2021. The cash and cash equivalent, that is the cash and the bank, then minus overdraft. But here we don't have the overdraft. Even at the start, we don't have short-term deposit. So I'm going to simply pick this as my opening cash and cash equivalent. So I put it here. I'm going to put it here. I'm going to put it here. So when I add this plus let me hope we are. Have I picked the right figure?
Yes, please.
Okay. So this will be your closing. This will be your closing cash and cash equivalent. Have we missed anything? Let me see, because this one should be giving you the same answer. When you get this plus this, what do you get? Cash deposits. Cash deposits you add. Short-term deposits are too liquid in a way that they can easily be converted into cash. So what does that one mean? It means that when you're getting cash and cash equivalent, you add the 2 figures. You add the cash and bank plus the short term. First add, then we see where we made a mistake. Looks like I picked the wrong figure somewhere. 136 and 920 plus
Short-term deposit and cash and cash.
When you add these 2, you should get the answer here, but I think you can't get
0.
What do you get here? Moses, I can't hear you.
192. Oh,
You
my
get
network is not
192?
good today. It's fine.
That's what you have.
060.
Yes, it's what we have.
Yes.
Then here, let me see, this plus this. It's different. Where is the mistake?
I think it is on
You,
dividends.
oh, yeah. We left out dividend. Yeah. Remember, we had this figure as dividend. Eh? We left out, you see this? Eh? Actually, that's how I normally correct myself. I first know what is the difference, then I work backwards. So it means that under financing activities, because dividend is under financing activity, I will just include. I will include the dividend here. I include the dividend paid, and this was working number what? The dividend paid was working number 2. Dividend paid was working number 2, and it was how much? That was 8104. I put it as a negative because it's a cash outflow. So when you do that, I believe your things will. I believe your things will balance. This one will be. You get this plus this plus. What am I doing? This plus this plus this. I believe your things will balance, and that's all. That's all. Understand the steps. These things don't normally change. Now, because I want you to master this area, what I'm going to do, I'm going to give you this as your assignment. Please, you go and try. Let me check the question here. Let me check the question here. Please, you try this number. That is August 2019. Please, you do and send me what you have done. This is question 1. You do. After doing, you send me what you have done. After trying this number and you find that we discuss it, we will discuss. But basically apply this knowledge, what you have learned from this session and the last session, and see whether you can really balance off. Don't copy. The problem is that now, if for you will say, I have limited time, I can't try. Please, you do without copying, without looking at the marking guide. I want you to understand this number. Okay, so colleagues, I want you to write this as we wind up for today. As we wind up, please, can you hear me?
Yes.
No additional information. Call it additional information. And say the proceeds information. Now, I want you guys to tell me how you can treat this as you're doing the number. How do you treat note number 1? How do you treat note number 1? How do you treat note number 1? Oh, you can't hear me.
I
Can you
think
hear
that one.
me?
Yeah, I can get you. I was saying the process from sale of non-current investment can be treated as an investment activity.
An investment activity.
Activity.
Yes, because when you check, you will check what? Okay, that is investment. The investment activity. That is true. That is true. You come here where you have investment activity. You put what? Like disposal, like here, like the same way we called this as disposal of machinery. So this one will be proceeds from what? These ones, this figure we have is proceeds. These are proceeds from disposal of machinery. So when you're handling cash flow and you're given that you put it this figure you put it under what? This figure you put it under financing activity. You put it under financing activity.
The proceeds, we take it
You
as
put it under financing.
financing activity.
Pardon? No, under investing activity.
Okay.
Sorry. Hey, this is investing activity as cash inflow. Investing activity. Cash inflow. Then, how do you handle note number 2? How do you handle note number 2? Fixtures and fittings with an original cost of shillings 85 million and net book value of shillings 42 million were sold at a loss. What comes into your mind? Number 1, you have loss on disposal. Are you seeing that?
Yeah. Yes.
Loss on disposal. Loss on disposal was how much? 13 million. 13 million. And what do you do with loss on disposal? This is non-cash.
Add back.
You add back. This is non-cash expense. This is non-cash expense. You add back. You add back at this. You add back at this. You add back at this from here, this side. This side where we have non-cash expenses. You add back at that no disposal. What else do you do? What comes into your mind? What else do you need? Of course, you need to know what was the disposal amount. Because you have the cost, you have the net book value, you have the loss. Can you get the disposal amount?
Yes.
First of all, how do you get loss on disposal? Loss on disposal is equal to what? Loss on disposal. Loss on disposal. How do you get loss on disposal? We compare two things to know whether there is loss on disposal.
You compare the net proceeds and the assets.
If it's loss on disposal, yeah, if it's loss on disposal, it means that net book value. It means that net book value is higher than the what? So you get net book value minus the disposal amount. Disposal amount. But if it's a gain, remember gain on disposal. Gain on disposal. For you to get a gain on disposal, the disposal amount must be high. So it is disposal amount minus the net book value. So you need this disposal amount. Why do you need this disposal amount? That will be the proceeds. That will be the proceeds from what? From disposal of your fixtures and fittings, which you put under investing activity. So here you will put how much? You will put 13. So it means that here my disposal, to make it short, disposal amount will be equal to, I bring this, it will be net book value minus loss, minus loss on disposal. Do you agree?
Yes.
Because I need a disposal amount. In the question, you're given a disposal amount, rather you're given a net book value, and net book value is what? Net book value was 45 million. 45 million minus the loss on disposal, which is 13 million. So finally, the disposal amount will be how much? That is 32 million. So this is proceeds disposal fixtures and things. You get the casting. Now, colleagues, next, how do you handle note number 3? When you're handling note number 3, what do you need? Let me hope you have understood note number 2. Note number 2, you will need to add back this. Then you will need to include the proceeds from disposal of fixtures and fittings and investing activities as cash inflow. Then next, number 3. What do you need on number 3? What do you need on number 3?
I think you'll be looking for the depreciation for the year.
First of all, note number 3, you'll be looking for depreciation for the year. What else? Depreciation for the year.
Acquisitions or disposal.
Depreciation for the year. Depreciation for the year will be the difference in the what? In the accumulated depreciation, isn't it? Which is 34,000, rather 340 minus 340 minus 290.
50.
That is depreciation for the year. Someone had a question?
I was saying
that is depreciation for
that
you add back at this, add back at this. It's a non-cash expense. So you add back. Okay. Then what else do you need? Do you need to see whether you have acquisition or disposal of what? Of PPE. That's what you need to see now. You need to test and see whether you have acquisition or disposal of PPE. And how do you get that? We are going to get the net book value at the start. The net book value at start. That is getting the cost minus the accumulated depreciation. Or you just say balance brought down. And what is that balance brought down? You have it. You have it. Balance brought down is this one. Because what you have here is net book value, this one, net book value. If you're not given that, you can first look for it. So you have the net book value. What else do you add back what? What did I say? You add back what? You add back the revaluation. The revaluation again. You add back what? You add back the leased asset during the year. The leased asset during the year. Then you erase what? The depreciation. The depreciation for the year. You erase what? You erase the revaluation loss. If it's there, revaluation loss. Then erase what? The asset that was sold. The asset sold. The asset sold during the year. The asset disposed. Asset disposed of during the year. During the year. And here you put the net book. What was its net book value? That's what you put. Then finally, you'll be in a position to get. You'll be in a position to get expected balance carried down, which is net book. That is net book value at year end. At year end. At year end. Okay. Please master this. The flow matters a lot. So you don't have revaluation in this question. You don't have this the asset, but you have depreciation for the year. So put that depreciation for the year, which is 50. You put it here. Then do you have revaluation loss? No. Do you have the asset that was disposed of during the year? Yes. And what was its net book value? Its net book value was what? Was 45. This one. Its original cost was 85, but its net book value was 45. For us, we put here the net book value. 45. Okay, so you will be in a position to get the expected. So you get this minus this plus this. Okay, so that is the expected. That's what you expect as net book value. But what is actual? The actual balance carried down is how much? The net book value at year end. Net book value at year end is how much? The net book value at year end, are you seeing this? The net book value at year end is this. So the question is, do you have the acquisition, or you have the disposal? Someone tell me, when you compare, what does this one tell you? Did the company acquire or they disposed the more PPE? You expected the value to be this, but the actual is this. So it means that for actual to increase, it means that the company acquired more PPE. So here you will have the acquisition or the additions. The additions. Or the acquisition. This will be like the acquisition of PPE. The acquisition of PPE. If the actual is less, then that is disposal. And the acquisition of PPE is investing activities, which is cash outflow. The cash outflow. The cash outflow. So colleagues, I believe when you meet these things, you will not fail. The only part that takes time when you're handling this is PPE. Because PPE, they ask the loss on disposal or gain on disposal. They test you on revaluation gain or revaluation loss. They test you, see whether you know how to get a disposal amount or acquisition of PPE. Those are the things that they test. Any
Excuse me,
question?
Abel.
Yes,
Yes,
please.
excuse me. Yes, if our actual balance carried down was lower than the expected balance, you said that we would be disposing of the PPE, right?
That will be the disposal. Yeah, disposal
How do you-
of
that
PPE,
would be
which is a cash inflow. That will be cash inflow under investing.
oh yeah.
Under
Okay, thank you.
You're welcome. Any other issue? If the actual is less, then it means that the company sold some assets, more assets. Okay. And when you sell, you receive, obviously. That is a cash inflow. All right. So colleagues, don't cram. Don't cram. Try to understand. Okay. So try to master. Maybe when I get time, I will discuss the direct method, but time is taking us really. But I will try. So that's enough for now.